Get back to the markets now. We've seen a bit of a change in momentum as we approach the final minutes of the trading day. Let's break it all down with Scott Bauer. He's the CEO of Prosper Trading Academy. Hey, Scott, how is it in the pit there?
You know, it's pretty quiet right now outside of the grand slam that Anthony Rizzo of the Cubs just hit, and everybody was going nuts, but it's actually pretty quiet.
All right, so it's pretty quiet. Everyone's getting out to enjoy this bizarre and crazy heat wave. You know what else is crazy? Just this back and forth. We're seeing all these governors. Pick your governor from the Fed that you want to talk about. If it's Williams, if it's Bullard, U.S. President Donald Trump coming out with his tweet saying he likes Williams Part 1, not Williams Part 2. How do you make sense of what's going on? Of course he does. How do you make sense of everything that's happening? And we'll get to where your predictions are with the rate cut in just a second.
You know, it's real difficult because we're seeing the Fed speak out of both sides, right?
Yeah.
We have some of the Fed presidents, Fed governors saying, you know, we don't need cuts. And then you have Williams, what he said yesterday, wanting to be just unbelievably aggressive. So it's very hard to discern actually what they are looking at. From my standpoint, my opinion, someone that's just in the markets every single day, I don't believe that we need it. The economic data that the United States has put out over the last weeks and even few months, although it's not incredibly inflationary or robust, it certainly, in my opinion, does not lend itself to being recessionary or the need for interest rate cuts at this point.
Okay, so Bullard is essentially coming out today. He says that we should have cut back in June. We didn't. So now he's making the case for a cut this month at the end of the month. He's saying throw 50 out of the window. It needs to be at 25. And to your point, we're getting a butting of heads here with respect to every governor seemingly want to steal the spotlight here. What you're saying, we don't need a rate cut at all, or do we need a 25?
I don't think we need it at all.
Wow.
Excuse me. The market wants 20. The market wants 25.
Yeah.
That's what they're going to get, and the market will probably be very complacent with it. I would say that if by some chance they cut by 50 basis points, I think the market sells off extremely handily, maybe in the range of 3 to 5%. The reason being because that is going to put fear into the marketplace, looking, beyond the economic numbers that we've seen, and institutions, everyone else is going to say, what is really wrong here? What is going on? So I think 50, that is just out the window, absolutely shouldn't happen. 25 I could probably live with. I don't think we need it. That's what the market wants, though. 25 would definitely be just giving the markets just even further juice than what we're seeing right now. Today notwithstanding, but boy, have these stocks been on a wild ride, Scott. They have been. I mean, you look at the market, and even with everything going on here, the market has just grinded, and we like to see a grind to all-time highs. And I think that's kind of why there's some fear out there. And that's why we're seeing the VIX trade where it is right now at the 13 handle rather than maybe down at the 11 handle or so, which we typically see in the middle of summer when there's not much volume going on, because people are fearful that we're at a top here.
Okay, we're going to throw up the VIX for our viewers and speak to it if you can a little bit. What I'm hearing is that there's just a little bit of complacency right now in the markets. What's your take on that? Expand your theory if possible.
So there is complacency, but when I look at the VIX, and that's what's trading right behind me here, and I see the VIX, near-term futures trading around the 13 handle. Historically, that's still on the very low end. But if you look at where we typically are at this time of year, in the middle of summer, when trading volumes are lower, that VIX handle is usually around 11 or 12. So even though we're not in the upper teens or even 20 when there's been market sell-offs over the last 6 to 12 months, we're still at a number that's fairly elevated. So there is some complacency, yet people are hedging portfolios, their overall equity portfolios, by buying VIX calls because they're very cheap. And that, in my opinion, is what's keeping the VIX a bit elevated.
Okay, when you do see the volatility, many say that if you're nimble enough, there's money to be made, there are trades to be done. Tell me, do you like the banking sector right now? Do you like U.S. financials? Is that a place where you could comfortably park some cash?
I love the banking sector, and not because I think we're going up 10, 15, 20% from here, but I think the worst is behind us. If you look at where rates were, the 10-year, just 1 year ago compared to where we are now, it's 100 basis points different, and yet the banks are all either unchanged or actually slightly higher than where we were a year ago. They have withstood this massive, massive decline in rates. And the other thing is, even though we didn't see it out of some of the banks this past quarter, trading revenues going into the third and fourth quarter, I believe, are going to be very, very strong because we've seen volatility in the marketplace. The banks, the big ones that trade, the Goldman Sachs, the JPs, the Morgan Stanleys, the one that have that trading portfolio, they love volatility. So I think they're going to get a double bonus here from extra trading volatility in the marketplace, and rates have pretty much bottomed out. Doesn't mean they can't go another quarter or so lower, but they have certainly withstood the worst of it.
It makes for a great headline right now, and it certainly gives us a lot of interesting fodder here as we discuss the Fed and we really dissect their moves minute to minute. But in the grand scheme of things, Scott, a 25, I know what you're saying about a 50. That seems quite aggressive. But if it's 50 by the end of the year, do you think that would spook the market? A 25 at the end of July, let's say another 25 down the pipe by the end of the year. Would that be okay?
It all depends what earnings come in between here. And we'll get two sets of earnings cycles in between to see what that growth is. I mean, if we get to December and we're still just kind of meandering along here, okay, we'll reevaluate that. But right now, as the Fed says, they look at the data. They're very data-driven. They're very data-dependent. And quite frankly, over the last 3-4 weeks, there has been nothing wrong with the data. Again, not inflationary, not robust, but certainly nothing that shows any signs of recession.
Yeah, jobs data, PMI, just yesterday, I believe, certainly outstanding.
You name it. Absolutely.
All right. Scott, we got to leave it there, sir. Have a great weekend. Thank you for your time.